Welcome to TheoTrade and the weekend update. This is Don Kaufman here on October 14th, 2017. Let's get right to it. With the S&Ps throughout the course of this week, well, what can you say about them? They're massively unchanged. The week started out right around 25.49. And for the most part, we ended the week at 25.53. So again, not exactly the spellbinding week we were looking for. If you trade on an intraday basis, wow, there were a few days out there where the S&Ps simply did not move. But you know what? That's all right, because in this past week, the bonds were in motion. And it just goes to say, if you are trading on an intraday basis, there's always some product, okay, that's in relative motion. Whether you're comfortable with the bonds, hey, that isn't the question over here. You could trade TLT, okay, there's always something in relative motion. With that and kind of the lack of movement, we're going to be very much forward looking. There's a few individual sectors that I want to talk about here on this weekend update and really give you, again, what I believe kind of is a turning point in markets to a degree. So first and foremost, let's get to some of the expected move discussion. For those of you that do tune in on a week-to-week basis, you know we talk extensively about expected move. That's kind of what I've boxed in here on the screen. This is how the option markets depict risk to be in the future week. Again, we're looking at the previous week, which had right around a $21 expected move. That means we can move about $21 higher or $21 lower. Okay, what did we actually do over the week? Absolutely nothing. We're well inside of what the option markets depicted risk to be. Now, in this coming week, what are we looking at in the SPX? Well, the SPX in this coming week has right around a $22 expected move. So what do we expect over here? $22 higher or lower. And you can actually see in the previous week, obviously, we stayed inside the expected move. The week before that, we actually did crack the expected move. So the again, before we really start looking at individual sectors, before we start going into a little bit more detail, it's important to denote that the volatility in the marketplace, the option marketplace, doesn't expect very much out of this next week. In fact, in the previous few weeks, we've seen right around anywhere from a $21 to about a $24 expected move. And again, that's specific to the S&Ps. All right, so let's start to take a little bit of a look around the marketplace and what I think is a bit of a turning point. We're going to start with the XLF, okay? The XLF, for those of you unaware, it's the financials. Now, the financials, many of them went through earnings, okay, this week. There's still a few more to come, but as I scroll down here to the bottom of my screen, you've had earnings out of Bank of America. Bank of America was actually slipping prior to the earnings. When the earnings came out, I'll tell you what, again, on an intraday basis, this thing was Mr. Toad's wild ride here. This was, again, Friday's trade, dropped heavily, rallied into the close. Bank of America, all right, really has been kind of the bright spot of earnings in the financials, up about 1.5%. Again, on Friday, and Friday morning is when it released its earnings. We had JP Morgan. JP Morgan actually slipping a bit, not too dissimilar to Bank of America in that it was slipping prior to the earnings. Taking a look at Citi, a fairly steep decline. Okay, Wells Fargo over here. And you have to stop for a second and you have to recognize when you start looking at, okay, so Bank of America, all right, great, caught a little bit of a bid, but on the week is down. And again, I'm actually going to flip the this to a percentage chart over here so you could just see on the pretty much on the week, well, the stock ended up down ultimately on the week on a percentage basis, which is Bank of America. You see JP Morgan slipped on the week, all right? Citigroup slipped on the week over here. Wells Fargo ultimately slips a little bit, you know, and then ultimately gets hammered on their earnings announcement over here and hammered by the tune of, again, about 4% on the week. Now, Morgan Stanley still has earnings yet to come, but the stock is already trading down. We also have Goldman Sachs. So why am I going through, okay, what really comprise this sector over here? And again, Goldman Sachs also trading down. Goldman Sachs with earnings coming out, okay, this next week. I'm talking about it extensively because when you start looking at the XLF, you'll start scratching your head. You're like, wait a second, the XLF is barely off. That's because one of the key components and the largest component in the XLF is actually Berkshire Hathaway. Okay. The thing that's fairly shocking to me is when you start looking at Goldman Sachs and Bank of America and Citi, okay, and Wells and JP Morgan, you realize these are $2 and even $300 billion market caps, okay? And they have massive influence to the entire marketplace. And yes, the XLF was slipping, okay? However, what the marketplace has become, and this is the marketplace as a whole, has ultimately been, all right, sell the weak. They're selling the weak over here and continue to sell the weak a little bit and buy what was working. It's the school right now of what's working, okay, right now. When you start looking at stocks like Facebook, anything, okay, and anytime capital is rotating out of a marketplace or out of a sector, in this particular case, a little bit of capital starting to rotate out of the XLF, okay, they're just popping it right back into the Nasdaq over here, which is locking the S&Ps inside of a range. So when you start looking at this, and you'll, I think, really start to kind of respect the moves that we're seeing over here, is here's the Nasdaq. And again, you could use the Nasdaq or the Qs. And if you looked at the Nasdaq, and I could even bring up a comparison chart, but if you look at the Nasdaq, it'll actually diverge from, and we'll make this little line, for instance, that is the XLF. Okay, so as the Nasdaq goes up, the XLF comes down, the S&Ps are ultimately caught right in the middle of that. And that's the action that we saw, which for the most part, if you traded S&P futures this week, you were like, caught in the middle over there. That's what we're seeing. Again, whether it's, they're selling retail. So everybody hates retail, right? Yeah, except they're selling retail and turning around buying Amazon. Okay. There's another market cap that's actually coming up over here, which happens to be Walmart. If you haven't looked at Walmart lately, you would think this is the latest, greatest tech stock. It's Walmart. Well, they announced a $60 billion buyback. So what Walmart has ultimately done, and I told you, we're going to look at a lot of individual stocks here in this update. What they've done in Walmart, okay, if you think about their board, the CEO, they've turned around and go, hey, these tech monkeys are pretty smart. And we could announce a large buyback. And by the way, we've also acquired a number of online companies. And hey, we'll call ourselves a tech company in the short term. Yeah, and they got a burst of what? 11% out of their stock. And ultimately 1, 2, 3, 4, 5 trading days. That's an 11% move. Okay, what a difference a week can ultimately make. And again, we're looking here at some strong market cap. All right, so kind of turn the tables here for a second. Back over to the XLF. In the shortest duration, okay, and this coming week, I expect the XLF to sell off a little bit. Again, I'm being very, very specific over here. Just in the coming week, all right, in the shortest duration, I expect the XLF to back off a little bit. Why? Okay, is it earnings? No. All right, is it the fact that Goldman's going to have earnings coming up? No, not necessarily. All right, Berkshire Hathaway? No. It's an interest rate play. So I've actually set up a little bit of a style over here for us to take a look at. If you look at what is going on in the XLF, okay, to what we'll call rates, this is just a quick comparison chart that I built, and I'll explain exactly what we're looking at. First and foremost, what are we looking at? Okay, on the very top up here, that little guy is the XLF. And what I've got it compared to over here is the TYX, okay? And then the TNX. Now, the TYX I threw up there, it's fine, okay? Interest rate, but the one that really I think matters over here to compare to is the TNX. The TNX is equivalent, all right, to the 10-year interest rate. So that's the interest rate that's associated. It's the interest rate that's associated, okay, with the 10-year notes. And that's what many of the banks trade on. So if you take a look at a comparison, there are obviously many similarities. As interest rates kind of come down, it brings the XLF down, right? And you can see they trade in almost relative tandem. And then we see interest rates spiking up, the XLF ultimately spiking up. Well, in just this past week, the interest rates came back down. And as the interest rates are coming back down over here, I have expectations that the XLF is not far behind. The XLF in just the next few days should descend. In fact, even the correlation study is showing that they're breaking correlation. What's the breaking correlation? Well, the breaking correlation is that the interest rates are coming down, okay? The XLF is not. And at this point in the game, I think that the XLF is going to play a little bit of catch up just in this next week, and on a percentage basis, again, kind of catch up a little bit with some of those rates. So again, take it for what it's worth, taking a look once in a while at the movement inside of interest rates and noting that the XLF, it's not moving, okay, again, at this time with those rates. So I have expectation, again, it will play catch up with it. So the XLF coming down very slightly throughout the course of this week. And very slightly could be, if you take a look at the XLF, open up the 6-day chain over here, they're expecting about a 44-cent move. And I think we'll probably see right to the edge of that range. And for those of you, if you're looking for like a cheap shot in this, all right, just a cheap shot for the week, you know, you can come in on Monday and you know, you can go out there and you can literally buy almost a 1 delta option. A 1 delta option. This is the 27 puts. What does a 1 delta mean? It means it's getting, okay, relatively a 1-for-1 movement with the stock. So that's a 98 delta option. And, you know, the market on here, again, the markets are closed, but the market on here, it's right around like 85 cents. What you're going to, you know, do is you risk 85 cents. And you probably get about 44-cent movement if there's going to be movement. You know, 44-cent movement to the downside is the most likely kind of occurrence out there. So decent risk reward. Okay, if you're wrong, what are you going to lose? Well, let's say they get crazy. We'll move maybe 44 cents to the upside, and you can lose maybe half of your investment over there. So nice little trade. Again, it's just for this next week. I don't want to go out any further than that. Okay, hey, listen, if we get surprised and the XLF declines more, spectacular. So another few stocks I want to mention before I go any further over here. Again, I was talking about a moment ago how markets have really become, all right, by ridiculous strength, which we've been seeing nonstop. And where's some of the strength coming from? If you haven't looked, Google, okay? Google is a lot of the strength. So buy the strongest stocks over there and sell the absolute weakest. And you want to see something in terms of weakest. This is one that Jeff Bierman has been pointing out here at TheoTrade time and again. You look at something like Bed Bath & Beyond, which is, you know, we've been kind of nicknaming it Bloodbath & Beyond over here because it is just that. So why do I bring up Bed Bath & Beyond? Do I see a wonderful investment over here? Okay, it's not for that reason. All right, first of all, the PE ratio is ultimately 5. And I'm not a big value kind of trader over there, but the PE ratio is 5. The dividend yield is almost up to 3%. And I think if you're not interested in investing in this, this is not a trade. This is much more of an investment. If you're not interested in investing in this, well, that's fine. But I want you to look at Bed Bath & Beyond as really kind of the poster child for what's going on in the marketplace. Underlyings that are already weak, okay, and are less in favor, they're just hammering day in and day out. And it's quantitative funds. And what these quantitative funds are doing, there is no more like, you know, forget about like the valuations, since I was just poking fun a little bit there at the PE ratio, but forget about valuation. They're simply rotating the market cap out, okay, of something like Bed Bath & Beyond. And it's, again, it's not because this is a bad company. It has nothing to do with that, right? It's rotation of capital out of what's weak into the school of what's working right now. And the school of what's working right now is to generate alpha. They're getting capital and their grubby paws on capital any way they possibly can, even if that means selling, okay, what's already decimated out there. So the point of Bed Bath & Beyond, when this underlying, and this is important, when this underlying starts to turn up, that is going to be the signal, okay, I think, for the unwinding, for example, of something like the Nasdaq or your Amazon, okay, or your Google. And yeah, we're using Bed Bath & Beyond of all underlyings as kind of the poster child for it. Now, you can look at a bunch of other underlyings. If you want to look at stuff like Macy's, you know, go for it. Again, there is nothing good going on in this sector. In the sector over there, if you're curious, You can pull it up also on XRT. The XRT, again, a little bit of a bloodbath this past week. You'll see inside, again, this is the retail ETF in percentage terms. Let's just quickly glance to percentage terms. Again, it was already down about 5% year to date. Well, it's down almost 10% now year to date. That's a 5% decline really in pretty much just this week of trading. You're like, well, what's going on in there? Okay, nothing. As I said, this doesn't have to do with valuation, nothing of the kind. It just has to do with like, hey, and what's the school of working right now? To seek a little bit of return, the quantitative funds are just ultimately, it's a spread where they're selling into what's weak. They're making money on the downside here, okay? Rotating capital into what's the school of working right now. And when they do that, the Amazons, the Googles, and the Facebooks, they have such large market caps, these underlyings like a Facebook or an Amazon or Google, it's just priming the Nasdaq higher and higher. And as I told you, okay, the XLF backing off a little bit is just trapping the S&Ps right in the middle. Okay, another underlying that happens to be a little bit of a poster child for the opposing is Caterpillar, okay? And in Caterpillar, we have been seeing day in and day out, again, explosive returns. You have to realize on a year-to-date basis, I just have to zoom back out for a second. You know, this isn't the latest, greatest tech company. It's Caterpillar, okay? Nothing really going on over here. And for those of you that have followed the company, is it a little bit of a turnaround story? Yeah, but they've been losing money, okay, with declining sales year in and year out. And the stock, okay, in just the recent few months has popped, okay, by the amount of 30%. I mean, you have to step back from this and realize, as I said, this is not about valuation of any kind. Do you think this company is really 30% better off than they were just a few weeks ago? Can you really make that argument? No, of course not, right? So at this point in time, okay, it's just the school of like, let's shove some capital in there, and they're generating returns on a day-to-day basis. And this quantitative funds don't really care what they do. Think about that. They don't care what they do as long as they're generating alpha. And it's, again, it's no longer a value marketplace. It's no longer about PE ratios. There's no technicals in here as well, okay? This is just a school of like, all right, let's see what's working. And if you do trade on an intraday basis, I want you guys to know this. You know, if you catch on to this early in a trading day, you can just ride some of these underlyings throughout the course of that trading day. So a lot to ultimately be learned from here. Last, but definitely not least, let's pick on Tesla for a second. So Tesla has some interesting news that came out on Friday after the closing bell, and I'll kind of wrap up a little bit with this. Tesla laid off about 700 people. They laid off they were performance reviews. This one inside of Tesla, okay, how this thing is going to open Monday is a big, huge question mark to me. Why? Are they really laying people off for, you know, they went through these evaluations, and if the evaluation didn't go well, you know, they have 33,000 employees, but they laid off about 700. It's cost savings. You know, in Q2, Tesla was burning $13 million a day. Literally, they were burning through $13 million a day. Let's see how the market reacts to this. You know, there's earnings right around the corner in here, and this does appear to me to be evasive maneuvers before whatever the earnings are coming out. Let's see how it opens up on Monday. And again, on Monday morning, I'll be talking about this in TheoTrade chat, because if the stock gets bid up in the morning, we may look to enter into a short position. But again, I suspect that this is a kind of a warning shot being fired across the bow, that they're burning too much capital, and these earnings may not look good. So what do? They scuttle 700 employees to bid the stock up prior to what could be some dismal numbers. We'll see how this one actually shakes out. Last, but definitely not least, a quick glance at the QQQ. So inside of the Nasdaq over here, the Nasdaq, okay, it didn't necessarily explode higher this week. I wanted to show you the expected move again, taking a look specifically at the Nasdaq, and I'm going to zoom in here for you, okay? The Nasdaq expected move kind of week in and week out has been right around $2. Well, guess what? This next week, the expected move again is $2. We have been trading, all right, this last week inside the expected move. A little bit of upward bias to the Nasdaq, but nothing too extreme. If you look at the Nasdaq futures, though, they're closing right on what we kind of call the roundy. It's 6,100. It's the roundy because it's a big round number. Again, a lot to think about in this coming week. Take a look at the XLF throughout the course of the week. If the XLF starts to really back off, it could put a little bit of pressure into the S&Ps, backing the S&Ps off. But what we want to see is capital just going to rotate out of the XLF and dive into technology. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.